Ladies and gentlemen, Asian guy here. We have spent years preparing for the war. We analyze the CFTC reports, we expose the JP Morgan flip, and we track the industrial famine. We know the price is going to explode. The math is inevitable. But today, I need to talk to you about the most dangerous person in this entire equation. It's not Jamie Dimon, it's not Jerome Powell, it's the person looking back at you in the mirror. Winning the war is one thing, surviving the peace is another. Many of you have been stacking silver at $20, $25, or $30. You have suffered through the smashes. You have held the line. But have you asked yourself the terrifying question, what do you do when you win? What do you do when you wake up, check your phone, and silver is $100, or $150, or $300? Most people think they will be happy, but history tells us that extreme wealth creation triggers extreme panic. It is called vertigo. When the numbers on your screen become life-changing, your lizard brain takes over. It screams, sell, sell, secure the profit. And this is exactly how the banks steal your wealth a second time. They suppressed it on the way down, and they will try to trick you out of it on the way up. We need to talk about the anchor bias. Your brain is anchored to the price of silver being cheap. You think $30 is normal, you think $50 is expensive, because that was the 1980 and 2011 high. So when silver hits $60, your brain says, this is a bubble, sell everything. This is the premature ejection of the financial world, and it is the biggest mistake you can make in a hyperinflationary reset. You have to realize that $50 is not the ceiling, it is the floor. Adjusted for inflation using the 1980 CPI metrics, the real high of silver is closer to $600 or $800. If you sell at $60, you're selling pennies on the dollar. You are handing your hard asset back to the very people, the banks, who are desperate to cover their shorts. The initial squeeze is not the end game. Look at the GameStop chart. Look at the Volkswagen squeeze of 2008. The first spike is just the shorts covering. The real move happens when the float disappears, when nobody is selling, when the price has to go to unobtainium levels to pry the metal out of cold, dead hands. If you sell your silver for $100 fiat dollars, what have you actually done? You have traded a scarce, strategic industrial asset for a depreciating, printed to infinity liability. You have jumped out of the lifeboat and back onto the sinking Titanic just because the Titanic has a nice buffet. The psychology of the exit is harder than the entry. Buying is easy, you just buy. Selling requires timing, it requires courage, it requires a plan. If you don't have a plan before the price spikes, you will panic, you will sell too early, or you will hold too long and ride the crash back down. We need to study 1980. The Hunt brothers squeeze, silver went from $6 to $50. But it didn't go in a straight line, it was volatile, it shook people out. There were days it dropped 20%. The people who sold on those dips missed the final rocket to $50. You have to be prepared for volatility washouts. When silver hits $75, the banks will orchestrate a smash. They will dump paper to drop it to $60. They want to trigger your stop losses. They want you to say, oh no, the run is over, and sell. But if the fundamentals haven't changed, if the vaults are still empty and the industry is still starving, that drop is a bear trap. It is a fake out. You must separate the price from the value. The price is what the screen says. The value is what the metal does. In a currency crisis, the price goes to infinity. Does that mean you should never sell? No, it means you must change the denominator. You don't sell silver for dollars, you swap silver for other assets. This distinction is critical. If you sell for cash and put it in a savings account, inflation will eat your profits in 6 months. The gain was an illusion. You have more dollars, but you can buy less stuff. That is the tragedy of the hyperinflationary winner. They become a millionaire on paper, but a pauper in purchasing power. The exit strategy must be based on purchasing power preservation. We are looking to move up the Exeter's pyramid. We are looking to move from a volatile speculative asset, silver squeeze, into a stable, productive asset, land, gold, business. Do not let the wealth illusion fool you. Seeing $500,000 in your brokerage account triggers a dopamine hit. You start mental accounting. I can buy a Lambo, I can buy a boat. Stop. That is poor person thinking. That is how lottery winners go broke. We are building dynastic wealth. We are building the foundation for the next 50 years. The first rule of the exit strategy is do not sell 100% at once. Never. This is called scaling out. If you have 1,000 ounces and silver hits $100, maybe you sell 100 ounces to cover your initial investment. Now you're playing with house money. This removes the fear. The stress vanishes. If it goes to zero, you lost nothing. If it goes to $500, you are still in the game. But selling for what? That is the question. The answer depends on the ratio, the gold to silver ratio. This is the magic number that professional stackers watch. They don't watch the dollar price, they watch the ratio. Because the ratio tells you when silver is expensive relative to gold, Right now, the ratio is around 80.1. It takes 80 ounces of silver to buy 1 ounce of gold. This is historically high. It means silver is cheap. When the squeeze happens, silver moves faster than gold. The ratio will crash. 61, 40.1, 30.1. When the ratio hits 30.1, silver is expensive relative to gold. That is your signal, not a dollar signal. A ratio signal. That is when you swap. You trade the volatile silver for the stable gold. You are effectively using the silver squeeze to acquire free gold. We will dive deep into the mechanics of this swap in the next part. But for now, you must steel your mind. The panic of the upside is real. You will see your net worth swing by the equivalent of a year's salary in a single day. Can you stomach that? Can you sleep when you are up 50K in the morning and down 40K by dinner? If you can't, you will make a mistake. You have to detach from the fiat number. 1 ounce, 1 ounce. Until the objective is met, the fiat price is just noise. The objective is freedom. The objective is exiting the matrix. And you don't exit the matrix by collecting more matrix tokens, dollars. Prepare your mind. Write down your exit plan on a piece of paper today. I will sell 10% at $100. I will swap 20% for gold at ratio 40.1. Make the contract with yourself now while you are rational. Because when the mania starts, when everyone from your Uber driver to your grandmother is talking about silver, you will not be rational. You will be emotional. And the market punishes emotion. We established that selling for fiat is a trap. If the dollar is collapsing, why would you want more of them? The goal is to acquire better money. And the only money better than silver is gold. Welcome to the ratio trade. This is the secret weapon of the dynasty builders. This is how you turn a silver stack into a king's ransom of gold without spending a single extra dollar. Let's look at the math. Currently, the gold to silver ratio, GSR, is roughly 80:1. This means if you have 80 ounces of silver, you can trade them for 1 ounce of gold. Historically, this ratio is an anomaly. The geological ratio, how it comes out of the ground, is about 8:1. The historical monetary ratio, Roman Empire, US Constitution, is roughly 15:1. The modern average is closer to 40 or 50:1. When the silver squeeze happens, silver outperforms gold. It's a smaller market. It's more volatile. It's explosive. Gold might go from $2,500 to $5,000, a 2x move, but silver might go from $30 to $150, a 5x move. When this happens, the ratio collapses. Let's say silver hits $150 and gold hits $4,500. The ratio is now 30:1, $4,500, $150, 30. At 81, your 1,000 ounces of silver buys you 12.5 ounces of gold. At 31, your 1,000 ounces of silver buys you 33.3 ounces of gold. Do you see the magic? You didn't put any more money in. You just waited for the ratio to tighten. By swapping at 31, you almost tripled your gold holdings. You turned 12 ounces into 33 ounces purely by playing the arbitrage between the two metals. Why swap to gold? Because after a massive speculative squeeze, silver usually crashes. It is the devil's metal. It shoots up and it falls down. Gold is the god's money. It is stable. It holds the high ground. By swapping into gold near the top of the silver mania, you are locking in your purchasing power in a much more stable asset. You are exiting the volatility, but staying in the hard asset ecosystem. This strategy requires patience. You have to watch the ratio like a hawk. You set targets. Target 1, ratio 50.1, swap 20% of your silver stack for gold. Target 2, ratio 30.1, swap 30% of your stack. Target 3, ratio 15.1, swap the rest, or keep a core position. If we ever see 1501 again, which happened in 1980 and 2011 briefly, your 1,000 ounces of silver would buy 66 ounces of gold. That is a life-changing amount of wealth preservation. 66 ounces of gold is a retirement fund, and you started with a stack of silver that cost you $30,000. This trade also has a tax advantage in some jurisdictions. Consult your tax professional. I'm just an Asian guy on the internet. In some places, like-kind exchanges or swapping bullion for bullion is treated differently than selling for cash. But even if you have to pay capital gains tax, paying it to acquire gold is better than holding fiat currency that is inflating at 20%. How do you execute this? You go to your local coin shop or your online dealer. You call them up. You say, I want to trade my silver eagles for gold buffaloes. They do this every day. They will charge a small premium or spread, but in the context of a ratio collapse, the spread is negligible. But here's the catch. You have to overcome your attachment to the silver. We love silver. We love the weight. We love the shine. We love the screw the banks narrative. But you cannot fall in love with the investment. Silver is the vehicle. Gold is the destination. Silver is the rocket that gets you out of the atmosphere. Gold is the space station where you live safely. Also, consider the central bank bid. Central banks are buying gold, not silver. When the monetary reset happens, it will likely be centered around gold. By swapping to gold, you're aligning yourself with the ultimate insiders, the central banks. You are front-running the remonetization of gold reserves. This strategy also solves the storage problem. If silver goes to $100, your stack is valuable, but it is heavy. 1,000 ounces weighs 68 pounds. It takes up space. It is hard to transport. If you swap that for 33 ounces of gold, you can fit your entire net worth in your pocket. In a time of geopolitical instability, portability is a form of wealth. You can run with gold. You can't run with a monster box of silver. The ratio trade is the ultimate gentleman's exit. You don't have to worry about the dollar collapsing. You don't have to worry about bank failures. You're simply moving from the undervalued asset, silver, to the fairly valued asset, gold, once the gap closes. Historically, the ratio tends to overshoot. It might go down to 10.1 or even lower in a severe industrial shortage. But don't get greedy. Pigs get slaughtered. 30.1 is a fantastic target. 20.1 is a dream target. If you catch any part of that move, you have won. Remember, the goal is not to have more dollars. The goal is to maximize your total ounces of precious metals. If you start with 1,000 Oz of Ag and end with 60 Oz of AU, you have performed financial alchemy. You have created wealth out of thin air using the ratio. This is what the rich do. They don't sell, they swap, they rotate capital. When real estate is expensive, they sell real estate and buy art. When art is expensive, they buy bonds. When bonds die, they buy commodities. You are doing the same thing on a micro scale. You are rotating from silver to gold. So when silver hits $100, look at the gold price. If gold is $2,000, the ratio is 20.1. Screaming buy for gold. Swap it all. If gold is $10,000, the ratio is 100.1. Do not swap. Keep the silver. The math guides the decision, not the emotion. This strategy requires you to be cold-blooded. You're betraying your silver stack to marry gold. But in the world of finance, loyalty is to your family's future, not to a metal. Swapping for gold is great for preservation, but what if you want cash flow? What if you want to build an empire? What if you want to own the land itself? This brings us to the second pillar of the exit strategy, the asset swap into real estate and hard assets. The cycle of wealth usually flows like this: paper, commodities, real estate, business. Right now, we are in the commodities phase. Silver is booming, but eventually the cycle turns. Usually, when commodities spike, interest rates rise and the economy crashes. This crushes the real estate market. We are approaching a perfect storm where silver hits an all-time high at the exact moment the housing bubble bursts. This is the opportunity of a lifetime. It is the chance to trade a high asset for a low asset. Imagine this scenario. It is 2026. Silver is $150. Your stack is worth a fortune. Meanwhile, mortgage rates are 12%. People are defaulting. House prices have crashed 40%. Commercial real estate is empty. There is blood in the streets. This is when you strike. You take your silver or the gold you swapped into, and you buy income-producing assets. You buy rental properties. You buy farmland. You buy a business that generates cash flow. Why? Because silver and gold do not pay dividends. They sit there. They are insurance. The land pays you. Tenants pay you. Crops pay you. The ultimate goal of financial freedom is passive income. You use the capital appreciation from the silver squeeze to buy the cash flow engine of real estate. But you must be careful. Do not buy real estate for dollars. What I mean is, don't look at the price tag. Look at the ounce price. Today, an average house costs $400,000. With silver at $30, that house costs 13,300 ounces of silver. In the reset, if the house drops to $300,000 and silver rises to $150, that same house costs 2,000 ounces of silver. You're buying the same house for 85% off in terms of your silver stack. This is how the wealthy buy assets. They price everything in gold and silver. When the gold price of real estate is at a historic low, you buy. But a warning on debt. Many stackers ask, should I pay off my mortgage when silver spikes? The answer is nuanced. If you have a 30-year fixed rate mortgage at 3%, do not pay it off. Why? Because inflation is your friend. The bank is losing money on that loan. You are paying them back with worthless inflated dollars. Let the inflation eat the debt. However, if you have variable rate debt, credit card debt, or high interest loans, kill them immediately. Use the silver profits to become debt-free. Freedom is the inability of any bank to foreclose on you. Being debt-free gives you the power to say no. Let's talk about lifestyle creep. When you cash out at $100, the temptation to buy toys will be overwhelming. A new truck, a boat, a luxury watch. These are depreciating assets. They go to zero. Silver goes to infinity. If you trade an appreciating asset for a depreciating asset, you are destroying dynastic wealth. Buy the toy only if the cash flow from your new assets pays for it. Use silver to buy a rental property. Use the rent from the property to buy the truck. Never eat your seed corn. Land is particularly interesting. Farmland, timberland, water rights. In a world of resource scarcity and supply chain collapse, productive land is the ultimate security. If you can swap your silver for 50 acres of fertile soil and a water source, you have secured survival for your grandchildren. You are trading symbolic wealth, silver, for real wealth, food, water. This is the barter economy mindset. In a hyperinflationary collapse, money stops working, but trade continues. I will give you 100 ounces of silver for that tractor. I will give you 500 ounces for that plot of land. You might actually be conducting these transactions directly in metal, bypassing the banking system entirely. The US banks know this. That's why they are buying land too. They are becoming landlords. Do you want to be a tenant of JP Morgan, or do you want to be the lord of your own land? The silver squeeze gives you the capital to opt out of their feudal system. Timing this swap is tricky. Real estate moves slower than commodities. Silver might peak and crash before real estate bottoms. This is why the bridge strategy, silver, gold, real estate, is often best. Step 1, silver squeeze. Step 2, swap to gold to preserve the gain and reduce volatility. Step 3, wait for the real estate bottom, 1 to 2 years later. Step 4, swap gold for land. This requires discipline. It requires sitting on a pile of gold while everyone tells you to buy stocks or crypto. It requires being a contrarian twice, first on silver, then on real estate. But the reward is generational sovereignty. You become the grandfather who bought the farm. You become the patriarch or matriarch who secured the family legacy. That is worth more than any Lambo. So look at your local market. Start researching now. What is the price of an acre? What is the price of a duplex? Calculate it in ounces. The duplex costs 10,000 ounces. Watch that number fall. When it hits 2,000 ounces, pull the trigger. The exit strategy is not about leaving the market. It is about rotating into the next undervalued sector. It is a game of musical chairs, and you want to be sitting on the most solid chair, land, when the music stops for the final time. Finally, we must discuss the hardest part. How do you know it is the top? How do you know when $100 is the peak, or if it's going to $500? Timing the top perfectly is impossible, but identifying a mania phase is possible. We need to look for the sentinel signals. The first signal is the mainstream media pivot. For years, CNBC, Bloomberg, and the WSJ have ignored silver or called it a pet rock. They hated it. When you turn on the TV and see Jim Cramer screaming buy silver, or when you see the cover of Time magazine featuring a silver bar, that is the top. When the establishment finally embraces the trade, it means the insiders are selling. They need the public to buy so they can exit. The second signal is the taxi driver indicator, or the Uber driver indicator. When random people, your dentist, your barber, your cousin who knows nothing about finance, start giving you advice on silver, it is over. When the general public enters a speculative mania, the smart money leaves. If your grandma asks how to buy a silver ETF, sell her yours. The third signal is parabolic exhaustion. Look at the chart. A healthy bull market creates a staircase pattern. Up, consolidate, up, consolidate. A mania creates an Eiffel Tower pattern. It goes vertical, 90 degrees. When you see the price doubling in a week, run. That is unsustainable. That is a blow-off top. The crash on the other side will be just as fast. Beware the bull trap. This is crucial. After the first crash from the top, the price will bounce. It will rally hard. Everyone will say, it's going back up. Buy the dip. But if the fundamentals have deteriorated, e.g., the ratio is flipped or the shortage has eased, this is a trap. This is the dead cat bounce. This is where the bag holders are created. Look at the commercial short positions again. If JP Morgan suddenly flips back to net short at $100, you follow them. If they start shorting again, it means they know the party is over. You do what the banks do, not what they say. Watch the CFTC report, if it still exists. Also, look at premiums. During the squeeze, premiums on physical silver will be insane. Spot $50, physical $80. But at the top, premiums often collapse. Why? Because people start lining up around the block to sell back to the dealers. When the coin shop has a line of people selling, and the dealer is refusing to buy because he has too much inventory, the top is in. You have to fight the greed. At the top, you will feel like a genius. You will feel invincible. You will calculate that if it goes up another $50, you will be a billionaire. That greed is your enemy. Remember your exit plan. I sell at ratio 30:1. Stick to the plan. Don't try to catch the exact top. He who sells early sells best. If you sell at $90 and it goes to $100, who cares? You made a fortune. If you wait for $110 and it crashes to $50, you lost a fortune. Leave the last 10% of profit for the next guy. Let the greater fool have the last crumb. Consider the regret minimization framework. What will you regret more? A, selling at $100 and watching it go to $150. B, not selling at $100 and watching it go back to $30. Scenario B is a catastrophe. Scenario A is just an annoyance. You still made money. Protect yourself from scenario B at all costs. Finally, remember why you stacked. You didn't stack to get high scores in a video game. You stacked for freedom. You stacked to protect your family from inflation, from bank failures, from government overreach. If selling the silver allows you to pay off your house, buy a farm, and put gold in the safe, you have won the game. You have achieved the objective. Don't get lost in the casino. Take your chips off the table. We are entering uncharted waters. The $100 level is a psychological barrier, a financial barrier, and a historical barrier. On the other side of $100 lies a world of extreme volatility and opportunity. But it is a dangerous world. The exit strategy is your life jacket. Put it on now. Don't sell for fiat unless you have immediate debt to kill. Swap for gold when the ratio tightens, 31. Swap for productive land when real estate crashes. Watch for the mainstream mania as the sell signal. This is how we win. Not just by being right about the price, but by being smart about the wealth. We are the stackers. We are the patient ones. We are the relentless ones. We survive the suppression. Now, let's survive the victory. I'm Asian Guy. Write your plan. Check your stack. And I will see you on the other side of $100.